Hi, and welcome to our Q4 edition of Macro Markets. Today we'll discuss a few key themes we're hearing from clients coupled with insights from PIMCO's Cyclical Forum. Our goal is to educate U.S. advisors and investors in a volatile environment while also setting the stage for our next CE credit session. I'm joined by my colleagues, Mary, Private Wealth Director located in the Northeast, John, Account Manager located in the Southeast, and then Antonise, not too far from where we sit today, here in the Southwest in California. Thanks so much for joining me today. Together, we'll discuss timely topics to the markets, such as duration, cash allocations, and munis. So let's get started. Mary, we were chatting before this about the growth in money market funds. Why do we think this is happening? I'd love to hear a couple of thoughts on this.
Well, it is pretty astounding to see how much money has flocked into the money market funds. But when you really think about it, it's pretty simple. 2022 was a rough year for both the stock market and the bond market. So investors are seeking comfort. And that comfort comes with a really nice yield today. So when you're looking at yields of 5.5% coming off of a money market fund, it's pretty compelling. The challenge, though, that I see with that is, money market yields are fleeting and yields are attractive across the entire bond market. So how does one think about that from a long-term perspective?
I think one of the big questions that I have my clients asking is how much do you want to save and how much do you want to invest? That saving is really great for money markets, but when it comes to investing, that's where we need to start looking out. And the biggest question that I get then is, when should I add duration and how much should I be adding?
I think the question needs to be asked, what is this money for? If we're to point out in the chart and showing the 2-year treasury, it's that the bond market tends to be ahead of what the Fed is doing, and that's why you can get a little more in 3-month T-bills and 6-month T-bills than you can in the 2-year treasury today, to the tune of 0.5%. There's quite a bit of reinvestment risk that you have on the very front end. So think about giving up 0.5% compared to the front end T-bills by going into something like the 2-year treasury. Yes, you're giving that up, but you're locking in that rate for a longer period of time.
You say bonds matter, and where they really matter most is when the equity markets are misbehaving, right? And for the first time in many, many years, 15 years, bonds, that diversification benefit has been restored. So should we enter a recession, even a mild one, and bond yields come down, that equals price appreciation. If we have a mild recession where equity valuations are today, you're likely to see equities down. So you want to have something to counterbalance that equity volatility. And that's really where looking outside of money market funds can be so helpful. The bigger question that I get, though, is I get it. I need to start layering in duration, but where in the bond market should I be focused on?
We're not in love with the volatility that we anticipate in the treasury market, but we're going to keep issuing treasuries to pay for stuff. At a certain point, you have to envision, where does the demand come from? We're going to keep issuing debt to pay for stuff. All the money is in these money market funds that owns T-bills already. What's going to absorb this? Just look at the 30-year national mortgage rate versus the 30-year treasury. That wedge is pretty significant. If we look at the agency mortgage market in particular, 70% of those mortgages are 3% mortgages or below. So if you're one of these people, you're not going to refinance. You don't even want to move. You are probably stuck in the place that you have because you don't like the trade-off of going to something like a 7 or 8% mortgage. So if we think about the supply-demand dynamics behind the asset class as well, we'll probably continue to issue a lot of treasuries to pay for stuff. And on the mortgage side, we're probably going to see very limited new supply, and you're getting a really handsome spread above treasuries with bonds that typically trade today, if you average all of them, around 85 cents on the dollar.
And still pretty liquid, right? The second largest asset class behind treasuries.
Yeah, but corporate bonds don't actually look horrible.
Yeah, I mean, you look at companies like JP Morgan that are printing cash. They have better fundamentals than the U.S. government. So you're seeing very attractive areas in corporate bonds. And so looking at high-quality corporates in the short-term space may be a viable solution for people who are looking for alternatives to money markets or traditional treasuries. I mean, bottom of the line, there's some of the cheapest bonds that we've seen in fixed income with mortgages and even munis. That's an area that's looking attractive as well.
Well, we can't talk about munis without talking about California. Antonise, you're based here. What are you hearing from the California-based advisors and end clients?
Well, I think it's no surprise that a lot of clients, especially in California, are looking for tax-free income. And right now, you're actually getting paid to be in that space. A lot of people weren't looking into the muni space beforehand because yields just weren't there. Now we're seeing investment grade munis at the highest yield to worst numbers that we've seen since the great financial crisis in '08. So it's a really attractive space to be in. And then when you look at the underlying fundamentals, there are a lot of states that are holding up because of the fiscal aid that we got in 2020. California being a great example. Right now, California's rainy day fund is $42 billion. That's 20% of the general fund. So if we were to get into a recession or a window of weakness, states like California are better suited today than they were in previous recessions.
In places like Massachusetts, taxes, despite being fiscally in great shape, taxes keep going up. Massachusetts just did the mass millionaires tax, which tax on another 1% on anyone earning over $1 million in income. And so the demand for munis is, of course, very, very, very strong. And because of that demand, a lot of the internal Massachusetts issuance gets gobbled up right away. But what I see even more, though, is Massachusetts residents now moving and leaving.
Welcome them.
But it changes your whole dynamic, right? Your state used to be all retirees. and now
Yeah,
it's
it
very
has. The
different.
investors changed, so now there's more demand for munis because there's different types of investors other than retirees, which has traditionally been, the majority of Florida. And so it's interesting that munis are at a 25-year levels, but we're seeing outflows in the muni space of over 12 billion year to date. But California, very attractive, Chicago, all over the country, munis are very in demand, and yields are at this very attractive level. So certainly, I think a very interesting time for munis, and Florida is certainly taking advantage of that, even though we're a tax-free state.
Munis do look really attractive and a place that we would take duration or interest rate risk. If you look at 10-year munis compared to 30-year munis, big difference comparing 5-year treasuries versus 30-year treasuries. You've got a pretty flat treasury curve, 5 to 30 years. In munis, you have a pretty steep curve, an area that we would feel comfortable taking on some interest rate risk.
And I think that's, just outside of munis, it's what we're seeing in fixed income altogether. A lot of people are understanding the value that's in fixed income. They're seeing these charts, but they're maybe not emotionally ready to get out into the market. And so that's why I think we're here to share that when you're building a portfolio, it's diversified, it's resilient, and there's also a lot of flexibility and liquidity in it.
There's a lot to be excited about in fixed income. Short-term strategies that we offer yielding 1 to 1.5% above money markets. Munis look the most attractive we've seen since the global financial crisis, though we've seen record outflows this year. So I think it's a great time to be looking at munis. And bonds matter within fixed income. You want to make sure that you're diversified and in a bend but not break strategy to take advantage of what the Fed's set us up for with these higher rates for longer.
Well, this was a treat. Hopefully it was valuable to the viewers. And thank you for joining us for Macro and Markets in Minutes. If you're interested in continuing this conversation on PIMCO's cyclical outlook, please visit us on our website, where we have a variety of resources, or contact your PIMCO account manager. And we'll be back next year for our full-length Macro Markets CE webcast. We hope you'll join us then.